Yes, Sirski, y'all know the vibe, man. It's your boy D-Wall, co-creator of Think and Gen Wealth, back at it again with another episode of our weekly updates. Today, we're going to be going over the Fear and Greed Index. We're going to be going over the indexes such as the SPY and my favorite 3 stocks that I'm watching right now. And on top of that, we're going to go over some of the economic news coming out this week to give y'all some insight of what's going on. Without further ado, this is going to be a quick video. Let's get straight into it. All right, so first things first, we got the Fear and Greed Index. As y'all can see right here, we are officially sitting in fear. And that's pretty interesting because it doesn't feel like fear. You know, typically when you're in your fear, you're usually in like a 5% to 6% pullback or something like that. But we're not even below, I don't think like 2%, 3% from all time highs, which is pretty interesting. I think that kind of shows that there's a lot more room to go up in this market. The reason where I fear right now, to be honest, I truly have no clue from yesterday. I don't know what happened yesterday. The only thing that I heard was that Google's VP had left to go to OpenAI, and Anthropic had lost somebody as well, I believe. But that's the only thing I've really heard. And I also heard that the thing with Iran is essentially not really a set full-in deal. They're doing like it's like a mini conversation they're having to finalize the deal, but they're getting ever so closer. But the market knows something's going to close out eventually. We're getting closer than we ever been. So I really don't know what caused kind of this little mini. It wasn't even a pullback. I would just say it's the Mag 7 pulling back. You know what I'm saying? But that's some of the stocks I'm going to go over later on today. But yeah, we're sitting in fear. Historically, this is where you want to buy. Yeah, extreme fear is when you want to load the boat at. So these are good opportunities in the market for sure when it comes to the Mag 7. We're going to go over that in a little bit. Boom. Let's solve to the economic calendar. Let me start sharing my screen. Yeah, so what we got coming out this week, right? So this week, yesterday we didn't have much. Today we're going to have PMI coming out. For y'all that don't know what PMI is, that's pretty much explaining how the services and manufacturing and other sectors of the economy are doing when it comes to the businesses. And the main thing that we're looking for is for these businesses to keep expanding. So if you see anything above 50, that means these businesses are expanding. If you see anything below 50, that means they're contracting, which isn't good. So historically, we've been expanding, which is good. This doesn't really move the market too much, but it's good to look at when it comes to the broader economy. That's it really for Tuesday. Wednesday, we have new home sales, which is going to be important. It's going to tell us how the consumer is doing. We had a pretty good retail sales beat the other day, which showed the consumer is still spending money and buying retail products. New home sales is going to be cool. I want to see what happens there. It's been improving for sure. But existing home sales have kind of been beating it. New home sales are beating existing home sales because the new home sales are now getting a lot more incentives when it comes to rate buy downs and things like that because interest rates are so high and existing homes can't offer that. So I'm very interested to see how this is going. Crude oil inventories, that's going to be okay. I mean, I don't think that's such a big deal because we know the Iran war is coming to a closure. And we still have a good, decent amount of oil in reserves. So not really much going on Wednesday. Thursday is going to be big. We have core PCE and GDP and initial jobless claims and PCE and personal spending and continuing jobless claims and GDP. Now, we got mad stuff coming out Thursday, right? But the biggest thing is going to be PCE and GDP for sure. For y'all that don't know, core PCE is historically what the feds will use to dictate if they're going to cut rates or not. That's their main gauge of inflation. But as we heard from Kevin Walsh last week, Kevin Walsh is setting up specific task force to dictate what actual economic data is best to be used when it comes to tracking inflation, which I'm super excited for because I've been rashing the feds for using this damn surveys and all this nonsense that why are we using that in 2026? That's crazy. So I'm happy he's doing that. So core PCE could maybe be a different type of inflation report in the future. It could maybe be something that's not really as heavily leaned on when it comes to the feds, which will be interesting, right? But I digress. That's going to be super important. It's going to move the market because the market wants to see core PCE come down specifically because core PCE excludes energy and food. So we want to see that come down so that way the market can calm down about potential rate hikes happening in the future. Okay. Also, we got GDP coming out. GDP is going to be super important because we want to see a beat from 1.6. We had a big pullback. I think we'll see a beat for sure because CapEx hasn't slowed down. And the consumer is actually doing pretty decent when you look at the retail sales. So that's going to be important. I think we'll see a beat here. Initial jobless claim is going to be important, but the real big hitters is going to be the PCE. Personal spending, of course, gives us a look at how the consumer is doing. more PCE. The biggest thing is going to be PCE and GDP for sure. It's going to be a big day in the Fed's balance sheet to see if they're quantitative easing quietly or the quantitative tightening, whatever the case may be. Boom. Then Friday, we have the 1-year inflation expectation from Michigan. These are going to be important reports. It's going to give us how the consumer is really feeling about the future when it comes to inflation and consumer sentiment, which makes up 60% of GDP. So that's going to be really important as well. But the big day is going to be Thursday. Thursday is going to have a lot of volatilities. If you're putting in any trades or anything like that for Thursday, I will hold back on it because a lot of days can move rapidly. Okay. Now, if you're thinking long-term swings, long-term leaps, those type of things, buy or hold, that's totally different. But day trading this day may be a little difficult. Okay. Boom. All right. Now let's get into some charts. Let's look at the charts. Let me pull this up for you. All right. Boom. So let's look at the SPY real quick. Let's zoom out. Let's go to the 3-year weekly chart. So as y'all can see, we're still in this uptrend and it's not dying down. We're still in a bull market. If I zoom all the way out to the 10-year chart, we're still heavily in a bull market. So we may see a little red, but you zoom out, look at the overall market. This is nothing. Okay. This is nothing, y'all. We're still in this bull market. We're still riding the trend, still not fighting the trend. The only thing I will say here is we're kind of sitting on this 21-day moving average right here. I think we do go a little lower because of the strap method, right? So this right here, these last two candles, this looks like a 2-1-2, a bearish reversal 2-1-2, which is historically indicating that you're gonna see lower lows. For y'all that don't know, the strap method is a type of candlestick patterns that you can study that can dictate where a stock is going to go or where its price action is going to go, right? So I said a 2-1-2 here. This will be considered right here a bearish reversal. You have a 2 up or a 2 down, and then a 1, and a 1 pretty much sits in between the last candle or inside bars, what you could call it as well. And then the next 2 down candle pretty much breaks the lows of that previous 2 up candle. And as you can see here, we're getting close to it, right? Because we had the 2 down here, broke the low here. We have a 1 that's sitting in between this candle. Now we essentially have a 2 down because it's lower than this candle. But I think this indicates that we'll see another candle below this that breaks the low of this candle. And then we can see something lower down to this 50-day moving average, okay? Now, do I think that's scary? Do I think it's got to sell everything? No, because evidently the thesis behind the market hasn't changed. All right. AI CapEx build out is still happening. These businesses are still spending bread, and AI is still the theme behind it. Okay. So I'm not really too worried about anything. The only time I would get worried is if he lost his 50-day moving average and we saw the 50-day curling down a bit. That's when I'll be like, ooh, we could see something down here or even back down here. Because we still have to fill this gap. This biggest gap is my biggest concern. So I think we see here eventually. We don't know when, but eventually we will see it. That'll be my biggest concern. If we see the 50-day moving average start curling down, we see a death cross of the 21 and the 50 MA, then I can see us filling this gap right here. But for now, I'm really not too concerned. We're literally $20 from all-time highs. So not too concerned right there. That's how I'm feeling about the indexes. Let's look into Amazon, right? Amazon is disrespected, man. So if we zoom out, go to the 3-year weekly chart, you can see that we are sitting on the 50-day moving average, which is historically a kill zone for me. I love buying in shares or dollar cost averaging when it comes to the big Mag 7 stocks at these levels, because historically this is where they bounce from. We zoom out to the 10-year weekly chart. You can see every time we touch this 50-day moving average, we bounce and we bounce and we bounce and we lose it a few times. Liberation Day, we lost it down here earlier this year. But most of the time, when we get down to this 50-day moving average, it's a good opportunity to get in some shares. Now, the reason I say shares and not trades is because of the IV. Amazon's an expensive, not expensive stock, but like 232 long-term leads is a couple racks. And IV, essentially what I use it for is my way to gauge if I'm buying shares, leaps, or swings. All right. So if I have an IV that's above 30, I'm looking in the swings only because those leaps are going to be a lot more expensive. If I'm having an IV above 50, I'm looking in the shares only because those leaps and swings and anything contracts for options is going to be very expensive. But anything below 30, that would be good for leaps because leaps are cheap at that point. You could buy time. Okay. So that's why I like shares here because we're getting close to that 50. And Amazon is an expensive stock as it is. Not expensive valuation wise, it's cheap valuation wise. But this number wise is 232 a share. But overall, where do I think Amazon's going to go? We had a double top up here. So we had boom, 2 touches, crash back down, try to have a little rally up here. We pulled back down to the 50-day moving average on the daily. I think we're going to see lower again because of strap method. We have a 2-1-2 again. So we have 2 down, a 1, another 2 down, and this 2 actually broke the low of this 2. So now I think we're definitely going to go lower and lose this 50-day, this 200-day moving average on the chart. I think we fill this gap right here. Let me get rid of this. Because there's actually like 2 gaps in the same location, right here, right here. As y'all can see, let me send this out. This whole 2 gaps right here. And this was a former line of support before. Okay, so I definitely think we're going to fill this gap at around 212. And that'll be a really good opportunity for Amazon when it comes to dollar cost averaging. I mean, we'll see what the IV looks like. If that's leap territory, I wouldn't really like a leap here until I see like a specific pattern or maybe a strap method that gives me confidence that will come back up. And that's a good opportunity to buy in. But if we're talking dollar cost averaging, I love buying shares to the downside on Amazon. And a lot of Mag 7, Microsoft, we've been talking about. I'm gonna go over Google in a bit. Meta is another one, but I definitely think we go lower, get down to the 212 range. So I'm gonna set my indicators for that just to see what happens. But yeah, Amazon's getting disrespected. It's always been getting disrespected for the past few years now. And I'm still a firm believer behind them. I mean, everyone uses Amazon. AWS is running on half the world. So Amazon's still a great company in my eyes. I do think we get back down to this 212 range. Next, let's go to Google. Google, the Googles. So Google's is a dog. The reason I like Google here is because let me zoom out to the 10-year weekly. As you can see, massive uptrend. We're still in this huge uptrend, but we're touching that 21-day movement average on the 10-year chart and the 3-year chart, which is a line of support that we historically bounce from on Google. If we zoom back into the 1-year daily, as y'all can see, I've been talking about this gap for a bit right here. This gap between 364 and 354, that gap has now officially been filled. All right. That gap has officially been filled. But the thing is, we lost support on it. All right. As y'all can see here, we're losing support here from this candle right here. So now the next line of support we do have is at that 309 at the 50 to 200-day moving average on the daily. Okay. And once we get down here, I think this is a great opportunity specifically for Google. Because Google, in my eyes, is going to win the AI race just because of how many methods of cash flow they have with YouTube, search, Android, Gemini now. They could afford to do a lot of things to improve Gemini or just undercut the competitors. So I really like Google. I was talking about buying dollar cost averaging them into the year. I love it even further down here. Do I think we get down there? The Mag 7 is getting disrespected, so I wouldn't be surprised. You know what I mean? But I definitely think the next level of support is going to be about the 310 level. And next before that is 267. Back when we touched that was back in early 2026 with the Iran war. So we shall see, but I do think we go a little lower. And again, you'll see a method. Another 2-1-2, right? Every time we see in this 2-1-2, that is a really good indicator of a bearish reversal. Okay, so I really like it. I really like Google as far as shares here. Again, IV is like 40%. So I'm not really big on anything when it comes to swings or leaps here. I'm definitely big on shares though. For swings, I don't know. There's nothing really here that shows me that it's a good like opportunity for entry for anything. There's no what's it called? There's no patterns. There's no anything like that. So I personally think entering as a trade here wouldn't be the best idea, especially because it'll be a little expensive. So yeah, I'm definitely waiting until this 306 level. I think it'll be a good opportunity to get a little chunk of shares for sure. But this is not financial advice. Do your own research on everything I'm saying, okay? All right. Last but not least, we have Netflix. Now, Netflix is wild. I don't know what's going on with Netflix. And I do know what's going on with Netflix. The story, this isn't the same. They're not really growing the way they used to. And that's warranted. I'm not saying just because they're not growing the way they used to means they're, I absolutely don't think that. But I don't think people are going to be used to the 20% per year compounding over revenue type of growth, which is okay. A lot of businesses mature, don't really do that as much unless you're a crazy moat like Google. All right. The reason I like Netflix, though, is because they're at that 200-day moving average on the 10-year weekly and the 3-year weekly. And on top of that, I think they're cheap. Just keep it a buck. I think they're mad cheap when it comes down to how much they've lost value in their stock. Am I trading Netflix? Absolutely not. As y'all can see with the IV, 99%. Hell no. Them leaps, them swings is going to be mad expensive. I think it's purely dollar cost average with some shares every day with Netflix. And I'm not saying like load the boat on it because there are, by valuation wise, there are cheaper companies like Amazon's cheaper valuation wise. All right. But this is low for Netflix, man. So I would definitely allocate $5, $10 a day, how you break up your portfolio and all that. Allocate some bread toward Netflix. I personally will be doing that because, again, every time we see a stock like Netflix and other stocks tuck a 200-day moving average, historically we see bounces. All right, historically we see bounces, and the 10-year weekly chart shows that. All right, until this time back in 2022 when we were in a bear market for a bit. But every time we got back up, there with Netflix. So I'm not too mad at that. I think dollar cost averaging some shares would be a pretty decent idea. I'm not gonna lie. I'm not gonna lie. But yeah, this is not financial advice. Do your own research and all of that. Boom. There was another one I want to look at, bro. What we did Spy, Google, Amazon, Netflix. Nah, that was it. That's it, y'all. Remember, y'all, it's not financial advice. Please do your own research on everything that I just said. If y'all got any questions, let me know in the comments or get hit us up wherever, DM us, whatever the case may be. It's D-War. I'm out of here.